Hey, this is Chris Franco, and you are listening to Compound Money Quietly, the CMQ Investing podcast. CMQ investors, welcome to the show. It's great to have you here. This is a special Sunday edition of the podcast. I am live with our friends on Instagram through the Charlie Munger Quotes account. But as you know, this is the other CMQ, and that is Compound Money Quietly, the podcast that I have to say is it's growing. And I appreciate everybody who's been helping it grow by spreading the word. That's really how podcasts, that's how they get popular. There's a lot of podcasts. I was doing some analysis recently about, we cracked the top 100 for investing in the U.S., which is, I look at that as an accomplishment because this is an independent podcast. If you look at who's in the top 10 or top 20, these are, podcasts that are part of iHeartRadio. They're part of, Dave Ramsey, the Ramsey Network, that have extreme, a large distribution engine that allows them to rack up the downloads. And so this podcast, I told myself when I started doing it, I'm going to judge if I should continue doing it based on how the market responds to it. And so the response from you guys has been awesome in the sense that we have a loyal listenership. We're not trying to be mass appeal. So this content appeals to a very specific kind of investor. I think the type of investors who will be very much actively involved in the stock market for years to come, because we're all trying to get better at investing. We're trying to become wiser as investors. So appreciate everybody who's been part of that. If you don't already follow on Apple Podcasts or Spotify, take a couple seconds to do that. It's very easy to kind of not do it because it doesn't just scream at you to do it. But if you do, you'll always get the latest episodes in your feed. You'll never miss any of the content. And I'm putting up new episodes every week, so I don't want you to miss out. On the other note, if you have yet to leave a written review on Apple Podcasts, that goes a very long way. I always mention that, but I know I don't like to ask you guys to do stuff that goes, to make you guys do work. But if you have 30 seconds and you want to leave a written review on Apple Podcasts, that helps a lot in terms of people discovering the content, as well as just helps my ego, helps my self-esteem when I read these nice reviews. But anyway, I want to take your guys' questions. I want to talk about a couple of different things that are just on my mind as an investor, and we can chop it up that way. So let's get to it. I've done an episode about basically how we're misled by well-known stocks. If we are familiar with the name of the company, if it's a brand that we know, a company that we know, we tend to be misguided in ways that you wouldn't otherwise realize. And so I did an experiment to myself where I was actually I was a scientist and the lab rat in this experiment. And what I did is I went on to one of these stock screeners. I think it was through Fidelity. And I made a list of any stocks that were in one particular industry, and then I pulled out all the metrics I wanted to see. And of course, it has the name and the stock ticker as well. And I put that into a Google spreadsheet, and then I made a random number generator and replaced the names basically where the company names were. I replaced that with random numbers that I then made a guide so I could see later, what company it was. And I went through and I looked at, there's probably 100 companies, and I looked at them just based on the metrics that were in front of me. So I did not have the name of the company as something to guide me. And it was really interesting, one, because some of the companies that I said, this looks interesting, turned out to be companies that I owned. But there were also companies where, I might have otherwise overlooked them. And there was one instance in particular where I was, I think right when I first switched the names with the numbers, I did feel kind of lost for a second. I had to get recalibrated. And so it showed me just how important or just how real that, I guess we call it that behavioral bias is, or that cognitive bias is, where we tend to give too much value based on the name of the stock. And there was an episode I did. Let me actually get the name of it so I don't just talk about the episode. You can go and listen to it if you're interested. It's called Why Investors Should Think Twice Before Picking Familiar Stocks. And that episode was released on the 7th of September if you want to go back in time and check it out. But so yeah, like I've talked about before, I don't just talk this stuff. I'm actually living it as well and trying to, learn from it and apply it and just be a better investor for it. And, for me, the way to judge that is over a long period of time. And it's been, I think what we're all going into here, guys, is I don't make investments based on what I think Fed policy will be. And that reminds me actually of a quote from Warren Buffett that goes like this: "Forecasting interest rates has never been our game. And Charlie and I have no idea what rates will average over the next year or 10 or 30 years. Now, with that said, interest rates can't stay this low forever. When interest rates rise, I think that's when as the expression goes, when the voting machine becomes a weighing machine, that's going to happen. And so the question is, if you hold individual names in your portfolio, do you feel like those are going to be, they're going to be okay when the voting machine becomes a weighing machine? There's a quote I have pulled up here from Seth Klarman, who's a legendary value investor. It goes like this: "At times when interest rates are unusually low, investors are likely to find very high multiples being applied to share prices. Investors who pay these high multiples are dependent on interest rates remaining low, but no one can be certain that they will. This means when interest rates are unusually low, investors should be particularly reluctant to commit capital to long-term holdings unless outstanding opportunities become available, with a preference for either holding cash or investing in short-term holdings that quickly return cash for possible redeployment when available returns are more attractive." So to kind of bring everything together here, if you recently purchased shares in a company that you have a certain conviction for, and maybe you haven't assessed all the different factors that might be causing you to make the decision and actually make a suboptimal decision, the question you have to ask is, when the voting machine inevitably becomes a weighing machine again, if that company takes a reset in terms of the share price just takes really like a deserved beating, are you going to have the stomach to ride it out? Because look, we can all say that we're long-term investors, and over a 20 or 30-year period, short-term volatility doesn't matter. But there's all sorts of ways that in this current climate, you could be buying into something with a false expectation as to what's to come. And I'm not saying, or I'm not trying to make any predictions about any individual names or even the market, but we do know that when interest rates go up a little bit, as they inevitably will, that can be I'll say the catalyst to turn that voting machine back into a weighing machine. And you could have, fallen victim to this idea of, buying a popular stock, thinking that, somehow it'll treat you right. An example of this that I've been talking about in some of these lives that I've not turned them into podcasts yet. It's about Rivian, which is the electric vehicle company that was, so heralded when it first came out. I've got a little coffee here too, by the way, so I'm going to be hyped up. Jeff Bezos actually rode out to go to space on a Rivian, or in a Rivian, and this company just was the belle of the ball when it IPO'd, and they just had their first quarterly earnings report. And there's a lot of conviction you have to stick with a company that is not making money. They've made, I don't think they've even put out 1,000 cars yet. And there's a lot of barriers in the way. So that company, sure, in 20 years, it could be a killer, but you're going to have to go through probably a really rough patch. And the question we all have to ask ourselves is one about opportunity cost. Is that the best place to have your money for the time being? Is there something you could be doing with your money that would be more sensible? And I think that's why assessing our portfolios now, before we get to a point where, just inevitably, I'm not saying the market's going to crash or anything like that, but there's just going to be a little bit less, it has to be less, the gravity is going to set in. I think that's maybe my own way to put this. There's this little bit in the market, and it's changing a little bit right now, it feels like, but, where the expression, stocks only go up, that idiom that really isn't true, but people say it like, it's a fact. If everyone likes to talk about the chart that shows, the S&P over, a 50-year period or something like that. When you zoom out, sure, it goes up, but that doesn't mean all the companies in it go up. That's the reality here. Not all stocks go up. Some stocks go away. And that is very much, I feel like, something that we do or talk about here that's a little bit different. Just trying to embrace reality, deal with reality. Charlie Munger has that quote, "Reality is talking to anyone who will listen." And so I'd say one thing with our community here, our CMQ Investing community, is we're listening to reality actively. And I believe that's one of the components that makes for a better long-term track record for us, as all of us as investors, no matter where, kind of you are in your own journey here. I might just upload that and keep it as is. If I put that part, guys, as a podcast, the last 10 minutes, would that be something that, you could listen to again and be like, I'm glad that's up here. Just give me some hearts just so I know. And because again, once we finish this up, I'll listen back and I'll be like, I don't know, it's not good enough. And I just get in the way. So I want to get out of the way and let you guys tell me if it's worthy. And again, the podcast is CMQ Investing presents Compound Money Quietly. It's on Apple Podcasts, it's on Spotify, and it's we've got a great community who's listening, so I appreciate it, and I see a lot of hearts. So this is my note to self to upload that as is. This has been Compound Money Quietly, the CMQ Investing podcast. If you enjoyed the episode, if you learned something, please give a 5-star rating and leave a written review on Apple Podcasts. If you haven't already followed CMQ Investing, make sure you do so, and you can do that on Apple Podcasts, Spotify, or any of the other streaming services where you can download and listen to these episodes. I really appreciate you being part of our community, the CMQ Investing community. My name is Chris Franco. Thank you again for listening, and we'll talk soon.